Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
This has been unbelievable. It was just so volatile. And I'm going to talk about this volatility, what happened. Like, for example, we had the chip, people who make the machines to make chips, who sell those machines to Taiwan or to TSM, to Micron Technology. They rallied pretty good the other day. But this morning, they had a problem. They couldn't follow through because yields went up. And when yields go up, that's bad for stocks. So they opened up on a high. They're opening high, and then they immediately went right to their low and then further. So there was no follow-through on what happened yesterday. But before I begin, we're going to talk about that. But I also want to talk about this. Drives me nuts.
We said this is the greatest investment environment I've ever seen. I still hold to that.
You do?
Yes, I think it's but I think what you're going to see now is much more volatility.
That's just a bull-faced lie, okay? That is not true at all, and I'm going to prove that. I mean, it's just a lie. So, but let's go back to yesterday, okay? So yesterday, the chip equipment makers, symbol ASML, AMAT, CLAC, LRCX, they all soared, right? So I'm going to take you to my chart right now. I want to show you what they did. So just follow me to my chart, and we'll take a look. So let's look at these are the guys that took off yesterday. These are the hot stocks. So look at the gap up that had yesterday. Big gap up yesterday. And look at the gap up on AMAT. These are averaged about 1.82%. I mean, that's quite a bit. That's a big day. So that's what happened yesterday. So this morning, what happened? Everybody's looking for follow-throughs, especially, the FOMOs, fear of missing out. They always jump in. So what happened this morning, they opened right away, gapped up on a little high, and they gave that high up, and then they went through their opening low, and they have not been able to gain today's opening high. So that's a weakness. Now, that's all of them. AMAT, CLAC, LRCX, they all had a gap. Now, LRCX didn't have a gap yesterday, but CLAC had a gap, AMAT had a gap, ASML had a gap. So what happened? Well, this morning, all of a sudden, the 10-year Treasury yield starts going up. And people were surprised. And what happened was those gains yesterday, about 1.82%, they gave a lot of that up today. Because, again, what caused that big gap up yesterday, 3 words, the classic Wall Street, right? After ignoring for months, they ignored our declining CapEx spending. They ignored the declining 9 out of 10 software stocks declining. They ignored the declining 5 out of 10 chip stocks declining. I mean, things were not going well. Only a couple stocks were doing well in the chip sector, including the companies that make the machines to build the chips. Those are the ones went up yesterday. So yesterday, in typical Wall Street style, we see them do this all the time. We saw it, as I said to you yesterday, we saw this on December 17th with Micron Technology. So what Wall Street does is they'll latch on to a point, to a data point. So after ignoring all this bad news, they latch onto this data point for dear life that TSM announced they were going to increase their CapEx spending from $41 billion to $56 billion. Now, that's a big deal. Now, remember, they're not doing that to build out a data center. They're doing it for the purpose of increasing capacity, semi-manufacturing capacity, expanding advanced packaging, supporting their chip demand. That's what the money's being used for. But they were stunned from 41 billion to 56 billion. But remember, that's that one company. Oracle's not doing that. So this morning, when the chip machine makers opened higher, they couldn't hold that high. They gave it back. And again, the reason is yields. Treasury yields went up. You always got to watch your treasury yields because your treasury yields are so important. Always tells you what your market's going to do. It never lies to you, okay? It never lies to you. And when yields are going up, that's bad. When yields are going up, that's bad for stocks. So bond investors this morning are getting upset, and they're saying, look, we demand long-term yields to be higher. We want the premiums higher because things aren't good. That's why when you hear this guy, say how, this is the best environment ever. I mean, come on. I mean, that's just crazy. It makes no sense.
We said this is the greatest investment environment I've ever seen. I still hold to that.
That's just a lie. So it's a lie because if it was true, we would have not seen the 10-year Treasury yields go up. And the 10-year Treasury yields, remember, they told us about a month and a half ago we're going to break 3%. Are you kidding? So again, the bond investors saying, hey, I want some yields here, man, because there's too much uncertainty. There's too much risk. And they give you the example, like the government 1.8 trillion deficit, which is now 5.9% of GDP. The 50-year average is 3.8 of GDP. So now you understand why they're getting antsy. So again, they want this extra compensation for also inflation's rising. We didn't hit that 2% target. What are you, nuts? Political uncertainty. Are you kidding me? We may be bombing Iran. Who knows? Maybe putting troops in there. We don't know. There's so much political uncertainty, right? We got Venezuela. We don't know what's going to go on there. And here's the big one that everybody's covering up, going, shh, don't talk about it. The doubt about the independence of the Fed under Trump is really disturbing people because investors, especially the institutions, because if he's going to put a man in there, he's going to raise rates when he should be cutting them. I mean, he's going to cut rates when he should be raising them. That's what everybody's worried about. So the best investment environment we've seen, no, that's a bunch of BS. So it's a strong environment. There's no question about that. But certain assets, like your AI, but it's not the best environment ever seen. You got to be nuts to say something like that. The reasons we got massive deficits now, rising yields, and they're going to keep rising now. Look at the bond market. Look at the 10-year Treasury. This is nuts. Look how long it's been going up, and it's been breaking out here. It's just crazy, and it's breaking out. Since December, we've been going sideways in consolidation. Now, the market has cracks in it. And if you look at the AI, which is the market now, the biggest crack is Oracle. Now, the reason it feels like a strong environment, I get that. I understand what's going on. It's because, again, we see the AI. Everything's driven by AI, earnings growth, okay? So AI is driving earnings growth. Semis and software are riding this once-in-a-generation CapEx boom, but only a few stocks. Remember what I told you yesterday. What Wall Street won't tell you is the semis, only 50% of the top 10 semis are doing well. And here's the killer. Let's take the software stocks. 9 out of 10 are no good. In downtrends, 9 out of 10. Go back, look 6 months. They're in a downtrend. Now, they keep talking about the strong spending, right? Well, the strong spending, let me tell you something. There's no strong spending. The spending that you want to say is strong is again, the 10% of the population They're the one that has the money. They have the disposable income. That's where the spending is. The middle 40% are barely spending. Barely spending, and when they do, it's buy now and pay later and using credit cards. The lower 50%, just cancel them out. They're not even players. They're not spending. Are you kidding me? Again, they're using these store credit cards, and they're buying now, they're doing that, and paying later. Now, corporate balance sheets are loaded with debt. How can you say we have a booming economy? Loaded with debt, what does that mean? Public corporations are in big trouble because they've been borrowing money at 0 to 4%. Now they're rolling that money over and the interest rates are 8 to 12%. The problem with that is going to start hurting because they're going to cut expenses. They're going to cut expenses. They have to. They have no choice. So what is the first expense the corporations cut? Labor, your job. You go from full-time to part-time to no time. And productivity is rising only due to AI automation. And the Fed, okay, they're expected to cut. But guess what happened? This week was the CPI and PPI. That's off the table now. They're not going to cut. They threw cold water on that because, again, the CPI and PPI weren't hot enough to cut. This idea we're doing terrific is just insane. Now, I want to show you some stocks. And we've been doing terrific with the stocks. Most of the stocks we've been staying with, let's take a look at the chart here. The stocks that we've been really working, okay, and I have them right here for you. Our GDX, our miners, our POS, our FedEx. Then you look at these are all good, strong stocks, relative strength stocks, meaning when the market goes down, these guys are holding, so we know they're good stocks. Also, our Goldman Sachs, Morgan Stanley. And if you tried to buy Goldman Sachs today or Morgan Stanley, don't ever do that. When you get a big move like yesterday, if you've been in these as long as we've been in, we sell into that big move. Now, if you want to get in, you don't chase that and get in. Let it pull back and give you a good buy signal, okay? TSM, MU, those are really the only tech stocks we're dealing with, okay? And then, of course, defense, we got GD, General Dynamics, doing good, and NOC. And again, industrials, FedEx, and CAT. And we're shorting about 3-4 different tech stocks. So again, when they tell you everything's doing wonderful, it's not. So again, this morning they downplayed the problem. This morning, when we didn't have a follow through yesterday with that big giant gap up in the machine, the people who make machines for chip building, that really told us something. And when you saw that 10-year Treasury yield taking off again this morning, boy, they played that down. But this is bad. If that term premium keeps rising, then we're going to see more and more people going into gold. Now, I tell my members, and I would like you to join our gang, philsgang.com, I tell them every day, gold, everybody asks, what do you think about gold? What do you think about it? It's going to continue to go higher. But we're going to continue to have 5 to 7% pullbacks. We've already had, I think, 3 now, and we're ready for another one. But it will keep going up because we got all these central banks who are buying gold. So, smart money, the institutions, they're dumping these tech stocks every time they rally. I mean, there's a host of problems. But again, if you're a good trader, you stay with the top tech stocks like we're doing, TSM and MU. But again, we are always taking profits, resetting our stops. Take profits, reset our stops. And we only buy on a dip to add to our position in the uptrend. We never buy on a dip in a downtrend. That's ridiculous. That's so bad. Wall Street's talked you into that because they don't want you shorting. That's why. When the market's going down, they don't want you to short. Why? Because they're trying to get their big players out, all the pension funds, police, the nurses, the teachers union, steel workers. And if like Enron, if Enron went straight, if they put a cell signal on that as it was turning over and going down, it would have taken 15 minutes for that market to go from $80 down to $4. Instead, it took months and months because the retail investor, okay, he's in there buying on dips, holding it up. So that's what's going on. So don't forget, starting Tuesday, remember, after we finish this show, we're going to switch to Instagram where you can ask me questions.